3, 2, 1.
3, 2, 1. Already.
Blast off.
Blast off. Here we go. 14 July 2024. Nothing going on this week in the market.
No, thank goodness. We've been a little busy otherwise. We're doing a whole lot of new stuff with the website. Excited about. We've got some new courses coming. Hopefully you guys will like all this stuff.
Yep, it's going to be good when we get all this launched.
Yeah. What you got for us
in the
this week?
meantime, that was kind of facetious because there's a lot going on in the market this week. It is about 1:30 on Thursday afternoon as we're recording this, right? So, today was a big day because there's some rotation going on. We've been talking about this sector rotation stuff for a long time, and it's given a chance for the Magnificent Seven to take a little break and some of the other sectors to kind of come online a little bit. What's really interesting is we've talked about the equal weighted S&P 500. RSP is the ticker symbol. But imagine if you took all 500 companies and they were all weighted the same. So it's not like you're taking, the Magnificent Seven out of the S&P, just that all the 500 companies are weighted the same. If you did that today, the equal weighted S&P is up over 1%, while the S&P itself, the weighted index, is down 0.8%. You got the S fund, which we're going to talk about quite a bit. S fund up over 2% today, with the C fund down 0.8%. So lots going on. It all comes down to CPI.
Things.
Yeah, we're gonna get into all that. But yeah, things are rotating. So unless you understand what's going on under the hood, you would have no idea. I mean, one day doesn't make a trend. But if today is the beginning of a big rotation, either you can wait and see how the C fund pulls back. It might just pause. But the S fund, if this thing gets going, the S fund has potential to explode to the upside. But we're going to get into it. All right. I got a lot of stuff to talk about, actually. Prognosticators versus technical analysts. A recent Facebook question, the events this week, ISM, we'll talk about that. Bonuses is VIX and the S&P, and then TSP charts. So prognosticator is one who has a crystal ball, I would define it as, versus someone who's actually looking at price. Okay, so it's a natural thing. Everybody wants to anticipate what's going to happen. Okay, there's basically three categories of, let's call them analysts. You got people that are primarily bulls. They're always looking for the bullish side, and they're going to justify why the market should go higher. They might be right, they might be wrong, but their analysis is fine. So there are bulls, and then there are bears. There are guys that think that the market's going to go down for whatever reason, and they're not, super smart, go to the same schools, they just have a different take on the data. And then there's the technical analysts that look at what's actually happening with price and go with the trend, right? So if you think that the market's going higher from here, you want to take a look at Ed Yardani. That's his main site. He's got a bunch of stuff on YouTube. You see him on CNBC and stuff all the time right now. He's one of the big bulls. Tom Lee, we've talked about quite a bit at Fundstrat. He's probably the bullish bull on Wall Street. He's on CNBC almost every day. So those two are really good for bulls. For bears, I think we talked about this guy, Marco Kolonovic, last week. It was either on the show or the newsletter. I can't remember which. But this guy lost his job at JP Morgan. I think it was last week, because he did really well in 2022. He was bearish and kept his subscribers from losing a bunch of money. But then he wasn't able to flip. His view was that the recession was coming, the market was going lower, and he held that view. He wasn't able to flip, and it cost him his job. He was one of the senior guys at JP Morgan. And then Morgan Stanley, this guy, Mike Wilson, he's also on quite a bit. He's pretty bearish. He's looking for a pretty big correction going into the election. He hasn't lost his job. But these are two guys if you think the market's going down. And so my point here is that really smart people can be on both sides of the fence. And then you got these two examples. So JC Pretz, we talk about quite a bit at All Star Charts. If you don't get his newsletter, you should. He's got great ideas. He puts out a ton of free stuff. This guy, Corey Mitchell, one of the best YouTube channels out there for technical analysis. It's really short term, so it's not, you'd have to sort of modify what he's saying in terms of TSP, because since we only, you get 2 moves a month and you got to have your trade in by noon to get that day's closing price. His stuff is much shorter, but the way he puts out technical analysis on his YouTube channel is really good. So those are kind of the 3 ways you can go about doing it. So if you're a bull and you're wrong, you're in trouble. If you're a bear and you're wrong, you're in trouble. If you can follow the price, you're not going to get all the gains and you're not going to take all the losses. So it just depends on how you want to do it. Okay. So recent Facebook group question. So this is actually a comment to a question. And he's talking about the S fund. If you've been following the show at all for the past couple of months, the S fund is in this triangle consolidation pattern. And so he says, I've seen those triangle discussions, but don't really know the best way to act on it. Looks like the lines are converging before too long, which is true. Does that mean it's best to hold and see what happens? Or go ahead and move to the C fund until there's a better signal to get back in the S? Thanks, learning a lot. Okay, so our response to him was, awesome, learning is what we're here for. We don't want to guess, okay? So the C fund is in this triangle consolidation. We don't want to guess which way it's going to go. You mean
the S fund?
S fund, yeah. Sorry. C fund is, has been making new all-time highs. It's up to like 35 new all-time highs for the year. So it just keeps going up.
Yeah, when we get to the fund charts, you guys, if you're not understanding what we're talking about, you'll see it. So just put a holding place right there. And when Jerry does the S fund later, you're going to see this triangle consolidation pattern. I'm
going to get to that actually the next slide. But so the thing is, we don't want to guess, right? We want to be in the stock funds when the odds are in our favor that the rally will continue. So that's what we were talking about back here, right? If these guys are watching the price, and when it goes one way or the other, they get in or they get out. These guys already have preconceived, they're already set up, they're already positioned. If you think the market's going higher, you're in the C fund. If you think the market's going lower, you're in the G fund. Like, from our perspective, that's what it is. It doesn't matter what the price does because you think you already know where it's going to go. These guys are responding to what price does. So what I was saying in the answer, we don't want to guess, right? We want to let the triangle consolidation of the F funds a great representation of the market right now. If rates come down and earnings stay strong, then all the stock funds will go up, right? If earnings disappoint, which this is the beginning of earnings season this week, so we'll find out. If earnings disappoint, the S fund will break to the downside out of that triangle consolidation, right? And all the stock funds are probably going to follow along with it. So right now, the C fund continues higher. The Grow Model portfolio is 100% C fund, has been since the end of April. Markets approaching a critical junction. S fund, which represents 4,500 companies versus the S&P's 500 companies, will tell us the next direction of the overall market once it breaks. So the reason is the C fund is dominated by that Magnificent Seven, right? Those companies have so much cash, it doesn't matter what the Fed does with rates for them. It really doesn't matter. When the Fed moves rates, it matters to the S fund, okay, and the F fund. But that triangle consolidation gets broken out when something happens with rates. So this is the chart when he asked the question, like the beginning of this week. Mm-hmm. This is this triangle consolidation we've been talking about in the S fund for, at least since back here, because that's when it started. Once you get a lower high and a higher low, you can draw the triangle. And now we're just waiting to see which way it's going to break out. Okay, so that's what it looked like when he asked the question. If the Fed raises rates, the S fund goes down because it's more expensive for those small companies to borrow money. To borrow money. It's different, so that they go down. If the Fed lowers rates, it's cheaper for them to borrow money. They break out to the upside. If the S fund breaks out to the upside, the C fund is already going up. So it probably keeps going. It might go sideways for a little bit, but it probably keeps going. But there's a lot of potential here in the S fund because this is just potential energy building up right here. Okay, that's what it looked like. This is what it looks like today. Okay, again, it's 1:30, so I did this at noon basically, and we're going to get to what happened. But the S fund is bumping up against that upper triangle line, right? Mm-hmm. Now it did it in one day. It's up like 2% today.
Yeah, yeah.
Okay, so this is a weekly chart. So, and it's Thursday afternoon. So take that into consideration about that candle.
Right.
Right.
And if you remember, Sunday when our weekly newsletter comes out, you'll see how that played out for the whole week instead of, kind of guessing. Sometimes we're a little early with the show just because of logistics and travel and things like that. Yeah. But our members never miss any of this. We never do it on Thursday. Right. But I think the takeaway for me anyway, looking at that, is that it's bumping up against it. So one or two things can happen, right?
Right.
It can bump up against it and roll over.
Roll over. Yep.
And we continue this, it gets smaller and smaller, but it can do that.
Yep. Or
flies right past it,
yep.
Right? And that can all depend on a lot of things, a lot of factors like Jerry's talking about.
If you're looking at this and saying, okay, I'm a little bit skeptical, if it gets above this high at 2100, right? Gets up here and breaks above 2100, it's going higher. That's a confirmed breakout. Okay. Because
not just the trend line, right? I mean, the trend line's great. It gives us a heads up.
Yes.
Where you really want to get it, involved is like when Jerry just showed you when it goes past that high.
Because what happens is right now the pattern is a triangle, but the patterns evolve. So if it comes up to 2100 and rolls over, now it can be a sideways channel.
It's just a
channel.
Yeah, exactly.
Right? And you don't know. You have to watch it and see what happens. Now, if you're like, nah, I'm good. I'm willing to risk it. And it closes this week above that line. Great. I mean, buy it. If your risk tolerance is there, buy it. If you want to wait until it gets above here to get more confirmation that it's actually moving higher, then do that. There's no right or wrong answer to this thing, right? Okay. So that's what it looks like right now. This is the other thing with the S and the C fund that it's amazing to me to watch people's sentiment change within the Facebook group or just sort of TSP as a whole, right? There are times when people are like 100% S, ride or die. Sometimes they're 100% C, ride or die. Sometimes, and we talk about it all the time. Yeah. Back in the day, 100% I fund made you way more money than anything else.
I know. But we call that, right? It's called fickle.
Fickle. Well, it's recency bias.
You're all over,
it's recency bias, right?
Right. That's a more professional term. Recency bias. I say they're fickle.
A little bit of both, yeah. So this one goes back to the bottom in COVID. Okay. So if you guys remember, it seems like it was a long time ago on the one hand, on the other hand, not so much. The F fund, the S fund, this is a percent scale. Okay. So the C fund is in black and the S fund is in orange. From the bottom in COVID, the S fund gained 140% in 1, 2, 3, no, not months. These are quarters. This is weekly, so these are quarters. Not long. Let's put it that way. From the bottom here to 140% on the S fund. Okay. If you compare that, like back here, actually compare it to here. So this is basically it was double. Right? The S fund was double the C fund's performance back there by the beginning of 2021. Now what happened? The C fund caught up to some extent, not all the way, obviously. But the S fund was absolutely killing it back then. And then if you fast forward, the C fund is now 25% more or less above where the S fund is. So obviously, if you can be in the funds that are outperforming, you're going to do a lot better than if you just have this mentality of nope, S fund is always the way, or C fund is always the way.
Yeah, and then look at the middle there, right, where they're kind of just going together.
Yep.
There wouldn't be anything in this chart, and this is important to point out, so you guys just pay attention. So why you want to look at these regularly, and I always forget what you call these.
Comparison charts?
Yeah.
Ratios.
Ratio.
Yeah.
We have them on the website. We've got ratio charts for all the funds. So you can see C versus S, S versus I, all that, right? And so all that time in the middle there, you got basically, a couple choices. do you evenly distribute, right, between C and S? Because nothing there is telling you which one's going to be. You can see where there's sometimes the C is beating the S fund there.
Sure.
Right? I'm sorry, that's the S fund beating the C fund. Yeah.
Either way. I mean,
either way.
Obviously, S fund's going up at a steeper angle.
Yeah, I'm talking about in the middle.
And, in the middle, they're the same.
Exactly. So I'm pointing out for that whole time in the middle, if you were ride or die one or the other, you're wrong. What you need to do is look at the ratio chart and go, okay, well, I don't know which one is going to, in a given week, is going to be up. So you could go 50-50, or you could just decide to say it doesn't really matter. I'm going to go 100, one over the other, right? This goes back to the same thing Jerry was just talking about, people who are bears and bulls. They've already got a preconceived idea of what's going to happen. They've already got their crystal ball figured out. All the folks that we see, we got 32,000 people in our Facebook group, and you see these big chunks of people that are basically the same way. Well, of course, then there's the fickle ones that just go back and forth. But the ones that like, no, you should be in the C fund. Okay, what's telling you that, right? Are you just thinking that? Is that what you've convinced yourself of, or do you have data to support it? We don't really care either way.
No.
This is what we're going to look at, right? One of these, and we're going to go, okay, it doesn't really matter right now. I'm going to be either evenly distributed or all in one or the other, and that's it. And then you got the times there where one fund is obviously outperforming the other, like right now. The C fund is obviously outperforming. The S fund is in a consolidation pattern, so you're going to wait it out. At some point, it may just shoot off like a rocket, just like you got there after COVID. You might see something just like that. So, but we're not set on the idea. We're going to watch and wait.
Yeah, we've been talking about for the last couple of weeks. S fund, it just has to prove it.
Right.
And maybe today is the beginning of that, but one day doesn't make a trend, and the day's not even over yet.
Right. And hopefully, guys, that's the bigger takeaway from all of this, right? Is not should I be in the S fund right now, right? It's I'm going to keep watching it till it does what it does, and then I'm going to respond to it. Right. You can only respond to it. You either guess or respond.
Yeah.
And you can make some pretty good arguments to guess, but then you're just gambling. And, if you're JP Morgan, you lose your job if you're gambling and you come up wrong. But, back to the chart. So
one thing I wanted to point out on this, you never see the funds moving in opposite directions. You got the S fund way outperforming the C fund here. They're moving in the same direction throughout here. Same. You get the C fund way outperforming, but the S fund is consolidating. You never have this
complete inverse.
Complete inverse.
Yeah.
Okay. You never see that, right?
It would be very difficult to happen.
Right.
Could happen.
So here's the thing.
Difficult.
Let's say today didn't. Well, here's the thing. You have this huge divergence right now between the C and the S. So either the S keeps going higher, and the C, it can consolidate, or it can keep going higher, but they're both generally going to be going in the same direction, okay? If the S rolls over, the C does not keep going higher.
It's just almost mathematically impossible.
Yeah.
It just is. There's some crazy things that could happen to make that happen, but it would have to be done specifically. Then it's not going to do that. The market is a whole group of people and companies. They're going to generally flow together.
Yeah.
You're going to be times when they're apart in performance, but not in different directions. That's right. That's almost impossible.
The C fund,
now we could say that the F fund used to be completely
inversely correlated,
but it didn't happen.
Yeah.
But this is different because these are all stocks and companies, and so that's not this. That's why it's really hard for that to happen. It can happen with bonds and stocks, but stocks and stocks.
No, not the indexes.
Nah, it can't happen.
Okay, so it looks like the S fund is breaking out, and if it does, that's great, right? You'll have to make a decision. Do you want to reallocate maybe from the C to the S? That's a possibility. You could wait and see what happens with the C. Does it go flat? Does it consolidate? Does it keep going up? I mean, who knows? It's down a little bit today. That's just money rotating from the C into smaller caps, and you know that because, like we said, the equal weighted S&P is up, almost 1.5%, and the C fund is down almost 1%. So, all right. So you get the idea of that. One more view of this. You go back to 2000, okay? If you started in 2000 and said, nah, I'm going to do S fund ride or die, you're a third higher than the C fund. Even with this big move, right? The C fund has been going straight up. The S fund's been going sideways. The S fund was so far ahead of the C fund, it's still way far ahead, right? But you can make the starting point anywhere, and the whole thing changes.
Right, that's the bigger takeaway is perspective is everything.
Yeah.
You can put that start line in a lot of different places and get a different story.
Yep.
What you need to do is put it in several places so you can get the full story.
Yeah. Well, that was the point of this, right?
Yeah.
Yeah. Okay. All right. So events this week. Fed Chairman Powell is up for 2 days for congressional testimony. He basically said, "Hey, we don't have the data yet to really bring rates down yet," which is fine. He's been saying that for a long time. And it didn't really affect anything. And of course, the C fund keeps going up because the C fund's not really affected by rates. But then on Thursday morning, CPI and jobs report comes out. So if you guys aren't familiar with this tradingeconomics.com calendar, it is the best thing going because it gives you all every major piece of economic data that's coming out on every day. And it gives you the times that it's coming out, right? So all this came out at 8:30 this morning. And then this other big one was at noon, was mortgage rates. But it gives you for the ones that they have forecast and consensus, it gives you the forecast and consensus for that. And it gives you the previous and then what the actual one is when it comes out. So 8:30 this morning, what happens? Core inflation month over month, okay? The previous was inflation went up by 0.2% from May to June, okay? The consensus was that, it's going to be 2% or 0.2% this time. The actual came in only 0.1, so it's half that. Inflation is coming down versus what they thought was going to happen, okay? So everybody looked at that and said, great, that means the Fed now maybe can cut rates, probably not in July, but probably certainly in September, right? And if they cut it in September, they're probably going to cut in November, and rates will come down, and that's great. And if rates come down, S fund goes up. That's why the S fund is going up today. All that can change tomorrow, but that's what happened today. CPI, and that's what everybody focused on. That was without a doubt the headline that Bloomberg and CNBC and everybody else was focused on. Jobless claims, 222,000, so less than what they expected and less than last time. So what does that mean? There are less people, saying that they lost their job over the past, this is week, so as of July 6th. That actually supports the what's it called? Soft landing. Supports the soft landing idea. So if the unemployment rate does not tick up, right? If we stay here below 250,000 jobs week after week, jobless claims, then people aren't losing their jobs. As the Fed brings rates down, S fund moves higher, C fund moves higher, F fund also moves higher, but not to that extent because it's just math. As the rates come down, the F fund goes up. That's the simplest, most straightforward. But a lot of this is very good because it lets the Fed reduce rates, and unemployment isn't ticking up. So they're still balancing the soft landing thing. The only other piece on this from today was mortgage rates. So the 30-year was at 6.95% last week, right? Almost 7%. And it came down to 6.89. If let's say it comes down to 6%, right? That'll generate a lot of housing activity. And that increases liquidity into the system, which actually goes against what the Fed is trying to do. So there's a lot of moving parts in here, and it's going to be really interesting to see how it rolls. As long as nothing breaks, as long as we don't have some kind of crisis somewhere that breaks something, it looks like a soft landing is happening, right? and maybe they kick the recession until next year or the year after or whatever. So for right now, everything looks good, and that's why everything is ticking up today. Okay. ISM Composite Index. So last weekend's Thoughtful Money weekly wrap-up with Lance Roberts, he put up these two charts that I'm going to show you guys. So ISM Composite, there's a manufacturing and a services component to the ISM Composite Index. So the U.S. economy now is like 80% services and 20% manufacturing. So what Lance does is he makes this economically weighted composite index. Okay, so when both manufacturing and services are falling, right? The economic activity in both of those areas are falling. You get below that zero line. He's got it at 50, but basically what he did is if you're below that 50 line, the shaded area here is recession. Okay, so you don't want to be below this 50 line. All right, this is dot-com crash, financial crisis, pandemic. And right now, we are just ticking down below that line. So this kind of goes to the idea of a potential something breaking in the economy. Okay, so you got the ISM Composite Index is telling us that the economy is weakening. Okay, when the economy weakens enough, you get these shaded areas, which is recession. Okay, and if we get a recession, the market's going to roll over. So everything's great today, but there's a lot of stuff going on behind the scenes. If you take that same chart, the red line, okay, so we still get the composite index. This is the S&P 500, but it's a rate of change. It's an annual rate of change. So rather than having it be in a line like we usually see it, all this is he made it a rate of change, made it around a zero line. Okay, so when the S&P is going up, it's above that zero line. When it's going down, it's below that zero line. Okay, so as you would expect, as economic activity increases, the S&P is above that line. When economic activity decreases, S&P is below the line. So where we are right now, we've had this big move in the S&P, right? It's been above the line for a long time. It's really strong. But at the same time, the ISM the economy is weakening, right? So it's not in line with any of this. When the line goes up, that's good. The economy's doing great. When the line starts rolling over, the economy's doing worse and comes down, right? This is another big divergence. So either the economy is going to start picking back up to support this uptick in the S&P, or if this line keeps going down, eventually the S&P is going to go down because the S&P is driven by the economy. So there's still a lot going on. All right, VIX versus the S&P. This is kind of interesting. So S&P 500 on top, and the VIX is the volatility index. A lot of people look at it as a fear index. Whenever the VIX spikes, it's coincidental. So it's not really a leading index. It's kind of coincidental. So like in this case, it's not a good one. Last summer, market's going down, the VIX spikes, right? So here's the thing about the VIX. It spikes because the market came down here. And then the VIX starts falling as price goes up, right? Because people are less fearful. So the VIX goes down, price goes up. When the VIX, eventually, you're going to have these little downticks in price. As long as the spikes in the VIX keep making lower highs, the market keeps going up. Okay? So I'm not talking about the little ripples, right? I'm not talking about these little downs. I mean, in general, the trend is going to be up as long as the highs in the VIX are lower highs. Eventually, you get some kind of transition, right? We start having higher lows in the VIX as we are approaching the top in 2022. Then we have the big spike, which was the beginning of the fall in 2022. And then every time the market's going down, you get higher highs in the VIX, right? Higher highs means the market's going down. And then, not incoincidentally, you got the highest reading on the VIX here and a little bit lower one here, which is a bullish divergence, right? Because there's less fear, even though price is lower in October of 22, price is lower, but the VIX is also lower. That's a bullish divergence. That was one indicator that this was actually a significant bottom in 2022. So where we are right now, this low in the VIX right here is lower than this low. So we're still, the VIX is going down, price is going up, and that's still where we are. As of today, you got this little uptick in the VIX, right? And it's a weekly line chart, so you can't really see it on the S&P, but obviously the S&P is down 0.8 today, and the VIX is starting to tick up. So let's say we get a move down in the S&P. As long as the next VIX spike stays below that high, and then it rolls over, this is going to just keep going, even if we get some kind of correction going into the election. Okay, so one of the things to definitely watch is whether or not we get a spike in the VIX above that high. Okie dokes. TSP fund charts. So C fund, if you're following weekly and you're making decisions based on this 20-week moving average line, everything looks great. You get a long way down on a percentage basis before you make a decision. If it gets support there, great, and keeps on moving, But if it breaks through there, you've already taken that loss, and that's where you're getting out. And if it comes down, you would have avoided any additional loss. But as of Thursday at noon, that doji is looking pretty ugly. So just something to watch. Doji is a reversal, right? We were as high as the top of that candle at some point this week, and now we're back almost down to where the week opened. So it's a bearish doji. S fund, we already looked at it, but here we are. We're right on that line. So if you think the S fund's going higher and you think that's a breakout, buy the S fund. If you want to give it a little more time, you want to make it prove itself, at least wait until the end of the week. This isn't the close of the week, right? So see what happens at the end of the week. I fund, same thing we've been talking about for a while. It was a really easy buy down here. We talked about it a few weeks ago because it hit that trend line, and it was an easy, not easy, it was a really good risk-reward trade if you had gotten into the I fund these 2 weeks that we were talking about it. In the long term, it's got to get above 82 because it hit triple top up here in 2021. 1, 2, 3, 4 weeks here in April and May, tried to get above it, couldn't do it. So it needs to get above 82 before we would really expect the actual trend to continue higher. And then the F fund, there's a lot of ways to look at this. This way I just did it as a head and shoulders. So if this is a left shoulder, this is a head, this is the right shoulder, this is the neckline. So if the F fund can get up here, say 99, it's going higher. The way the F fund goes higher like this, though, is if the C fund is crashing. F fund will go up just because of the math. As rates come down, the F fund will go up. But if the soft landing thing works, rates will come down, F fund will go up, but the S fund will skyrocket. So if you want to be in the funds that are outperforming, you need to know underneath why. Like what? So the F fund is going up, I should be in the F fund, right? Well, sure, you could be in the F fund. But you'd probably rather be in the S fund under these conditions. All right. Lots more in the newsletter this weekend. So you should subscribe to the newsletter.
You absolutely should, if you haven't already. If you guys like what you see, please share it with your friends. If you have any questions or comments, you can always put it in the comment section wherever you find the video. If there's not a comment section, shoot us an email at support@growmytsp.com, and the support team will shoot it on over to us, and we'll do our best to either maybe even get it in the show, or we'll just answer you directly. Hope you guys enjoy the show each week. And what do you got? Anything else up?
We're good.
Let's get out of here. Music.